Well, hello friends again. As we look at our investing stage, we've looked at stocks, and again, the risk inherent with that. Is there is there a vehicle that we could use that we have other people or even AI that's managing the portfolios? I mean, I would like Tesla, I would like Apple, I'd like Walmart, I'd like General Motors. I'd like a bunch of different stocks, but I can't afford all those at one time. And is there another vehicle that I can somewhat reduce risk by having lots more diversity? Well, here it is. Pardon me. The mutual funds and exchange traded funds. I think you'll like this section, and you really would like this in your 401ks, your 403bs. 401k is for profit businesses, 403bs are for nonprofit, 457 plans are government. Those are boxes that you put investments in, and this could really help drive your retirement and your investments like that. And you can just open them up just as a separate investment as well. Let's look into it. So mutual funds, these are investments that pool your money along with many other investors to purchase shares or collections of stock. Bonds, securities could be, again, we can make up anything that we wanted to put in there. Real estate, absolutely. Bonds, you name it. Companies that are green companies, there's nothing that probably they could not invest in, provided that's going to return some sort of income. So, typically your mutual fund has a team, has a portfolio manager, and has lots of people underneath that continually drive the market looking for the best deals all the time to put into your fund, and you buy shares of that fund. So it's like you're buying stock, but you're buying shares of a mutual fund that invests in the stocks that you might like. So about half of the U.S. households in the United States invest in mutual funds. Why? It's easier. Okay, I don't have to track the stock every single day, an individual stock. It's professional management. We're diversified. Real diversification is not things that look different. It's things that think different. So if we have a lot of tech stocks, and we have some retail good stocks and some manufacturing, some defense company, and we throw some bonds in there. Wow, now we're really diversified. Again, if we take one company, something could happen to that one company, and it could go bankrupt. We looked at Enron. But if it happens into the entire market, well, then if every mutual fund goes down, and we're somewhere, a meteor has hit us, the asteroid attack has come, the Clone Wars, Armageddon, something really bad has happened, and we may not make it out of that. And again, that typically is not going to happen with a mutual fund. Hey, it's going to be in the world if it does. So we spread our investment risk over hundreds of stocks in many different industries. That's why people really like the mutual funds. Lots of characteristics. There could be a closed fund. Okay, already set supply and demand on a closed fund. Now, a closed fund means we've got all the investors we need, and it's not open for sale. All right, it's sold. Now, you may be able to sell those funds out when you need to, but they're not accepting new investors unless somebody else is willing to sell out. Again, open fund means it's open. You can buy shares. All right, we could have loads, we could have no loads. Just always remember, these companies will make money, and our job is not for them not to make money, it's for them to make money for us, and we will pay their fees because they are professionally managed in the mutual fund world. Wow, over 9,000 investment companies, on any given day are ready to take your money and let you invest in their funds. These are shares, okay? And again, you can buy and sell those at your discretion. You can move them within your retirement accounts. Again, if you have a Roth IRA, which we talk about in the last section of the course here in estate planning and retirement, but that's a tax-free vehicle, my friends. You can put, the IRA is the box, and what you put into it is the investment. So you can utilize these mutual funds as your investment, and then you can find, again, the company that's going to hold your IRA would be like a Fidelity or a Vanguard. Those are giants right in there. And then you get to choose what funds you want in your IRA and 401s and retirement, and you really want to actively manage that. So this is why I think this is maybe the most important area of our investments, is understanding how the mutual funds and the exchange traded funds work. So we have a net asset value. We look at this is the value of the portfolio minus liabilities. It's the accounting equation. Assets minus liabilities is your owner's equity. And then once we get that equity, we divide it by the number of shares outstanding, and we get to know what the net asset value per price is. And so we have $655 million worth of assets. We have $5 million worth of liabilities, and we have 30 million shares outstanding. Gives us a price of $21.67 per share. That's how we find out what those shares are going to be worth. So interesting, friends. I think you'll like mutual funds. I think you ought to really look at doing a lot of research in this area, as well as exchange traded. There's all sorts of types. So there's no load funds, which means I am not loading. The broker does not put on extra pricing when you buy or sell those shares. There's a loaded fund. I mean, okay, we will put a commission on. Again, it depends on the performance and how good the organization is. If we could get back into the Magellan Fund, it's a closed fund right now. The Magellan Fund from Fidelity, it's one of the longest running mutual funds that Fidelity has. I think it was started in the 1960s, maybe even earlier than that, and it's produced a 12% to 14% return for the last 50, 60, maybe 70 years. We would love that, because 72 divided by 12 is 6. Every 6 years, your money's doubling. It's a closed-ended fund. But again, they can certainly charge a premium to get into that. The front end is when you purchase it. The back-ended fund assesses your fees when you sell the fund. You'll mainly see this, because this is probably, the front end is a smaller number. The back end is when you've had your money in for several years, maybe decades, and you want to start taking that out for retirement or for other things you want to buy. It's a bigger number, and so we'll put the commission at the end of the chain, not the front. There's always management fees. Okay, average is about 0.5% a year. So again, you have 1,000, 10,000, 100,000. You have $1 million in that fund every year. A management fee of 5%. Well, excuse me, 0.5%. Will take place, and so basically that's a $5,000 fee. I'm just trying to do it on my calculator for you. Again, my friends, they're going to make their money. We look at these, but we want to look at performance. There are some very expensive funds that charge 2%, but they may be giving you back a return of 25 to 30%. I'd pay the extra 2% management fee for something that good. So all in all, on averaging, if you can find 1% or less, that's a very good rate. But again, we're open to, what's the performance? Well, again, mutual funds have lots of classifications. They could be stock funds. So just the stock market that we just talked about. So you could say, you know what, I want to invest in a mutual fund that's mainly high tech and very aggressive because I'm young. Okay, the risk is inherent in everything we do, and certainly in the investment world. But if I'm looking at my age, and I'm looking at, again, I'm in my 20s, 30s, I may be even in my late, maybe 19, I would go aggressive, because you have a long growth pattern for you in your career. You're probably not going to be able to retire until 70. And so let's have the ups and downs, but we're going to have more ups than downs, and we could really get some good traction and average 12% a year for the next 40 some odd years. If I am in my 40s, 50s, 60s, and I'm still working, but I can see retirement in the future, and I want to protect. Okay, so we're accumulating when we're young. We are protecting when we become more mature. Equity income funds, global stock funds. There's just a large number of different funds you could get into, and this is what you would study and look at. But these are great ways to take advantage of different markets that it would be difficult if you had to buy single stocks in every one of those sectors. Growth funds, index funds. So when we look any type of an index, we're indexing a market like the NASDAQ, like the Dow Jones, and so we're picking companies in those indexes. Standard & Poor, S&P 500 is simply the largest 500 corporations in the United States. Those indexes peg those companies, and again, trying to get a nice return. We've seen that the index funds do very, very well over a long period of time, and so you could get right into that. You get an international fund. Again, you could just invest in large capitalization funds that are very big corporations. Usually, actually, it's more than $8 billion. With inflation now, it's probably closer to the $15–20 billion worth of capitalization those companies have. That's what all of those stocks in that fund would invest in. Mid-cap, regional, sector funds, natural resources, oil, gas, energy. There's 9,000 different funds, and so find the ones that you want. Social responsibility, again, those funds have been actually doing. You say, well, I just want money. Okay, well, do you care about how the company operates? That's a social responsibility fund, and they've done quite well. So again, we're looking at these. We can invest in them easily. We can also utilize these in our long-term planning. So more than likely, you're going to have a 401k as your retirement vehicle. And I talk about this extensively in the, wrapping up your financial plan with retirement and estate planning. But you want to control that. If you don't make any designation when you get your 401k, it's more than likely going into an interest-bearing account. And that's not good for us. We need risk, we need growth and accumulation to carry you through your retirement years. I want to do bonds. This is what someone who might want to protect their income at different days of their lives. Municipal bonds, that's going to be all tax-free interest. Those are very small interest-bearing funds right now. But again, there's no limit to the kind of funds that you would have. High risk, junk bonds, if you want a higher rate right there. Treasury bonds, corporate bonds. Many funds in themselves will have a conglomeration. So I could have stocks and bonds. There's real estate funds. Like I say, you can do a lot of research and find the sectors that you want to invest in. There we are, the sectors right in there. So oil and gas was killing it. And I mean, we're a geo-petrol economy. Don't think we're not. We're not going to be all electronic vehicles. There's much debate who has a larger carbon footprint. Is it the Toyota Prius or is it the Toyota Tundra? And they both come out to about the same. It's not easy making electric cars when you look at their total global footprint. So we'll always have oil, We'll always have high tech. We'll always have stores and things that we want to shop from. So again, slice of the market focuses on that particular business. Could be healthcare. A lot of different things, my friends, that you can invest in. Asset allocation, the balanced fund, that's become very popular because you're thinking right now, wow, I'm overwhelmed. Do I do a little bit of everything? Could I get some fixed income? Could I get some small cap? Could I get some large cap growth? International and alternative energies? Yes, those are called balanced funds or asset allocation funds. So they invest in a little bit of everything. Again, they may even say, here's a fund like a 2070 fund or 2080. So if you invested in today, it's pegged for the next 30, 40 years. That means in the very beginning of it, it would be high accumulation, and towards the end, it would shift itself into income, stocks, different bonds, treasury bonds to preserve that money. So you can basically say, hey, I'm very happy with how that's going to be managed, and so all of my 401k money is going into that because there's a lot of diversification in it. Life cycle funds, money market funds, like I say, my friends, there's a lot to look at, and you can have different funds. I mean, I can have a stock fund, I could have a mutual stock fund, I could do one in real estate investment trust mutual fund, I could do one in natural resources with oil and gas, and then have some municipal bond funds, and those could all be feeding in to my IRA or my 401k or 403b. That's what's kind of cool about all of that. And that's what we look at the family of funds. And so, which are those life cycles. So many times when you have different accounts, let's just say I think something's going to go weird here, the market's going to go down, this is a tricky game, so I'm going to take my aggressive funds and move them into a bond fund or move them into a money market fund. I can do that without paying the tax. I'm not cashing out, I'm just moving. And that's what you can certainly do in your 401ks and your IRAs. So this is what I think you're going to be doing much of your investing in throughout your career, certainly when it comes into your retirement. So that's mutual funds. Its cousin, little sister maybe, is exchange traded funds, and they're not that little. These are very big funds. They've come on very strong. These are funds that hold assets, much like a mutual fund. Stocks, commodities, bonds. It's pegged to an exchange. The one thing about a mutual fund, if I could go back just a little bit, the mutual funds are great for long-term investing. They are not that great for short-term investing because of the fees added to it. They may take a little longer to adjust. That's just probably the only drawback to that. If I'm trying to save up and invest because I want to make a big down payment on a house in the next few years, a mutual fund may not be the best way to do that. Maybe I do want to play some more in the stock market, or I want to try exchange-traded funds. So they are like a mutual fund, but they react faster to the market, and I hope that makes sense because it's tracked to an index. Exchange-traded funds, most of them are using artificial intelligence, so they're based on algorithms that have been written out by financial gurus and high-tech people, and so it's AI that's managing. So it's buying and selling all day long and then readjusting to the market. So again, kind of a new kid on the block. Basically, by 2013, they became very, very popular. So I think you might like this. Again, they could invest in a variety of indexes. They're not actively managed by portfolio managers because it's managed. It is actively managed, but it's done by AI. And right now, we got about 2,000. So that's pretty strong. I love this app. Now, this is the app that I personally use a lot. It's called Acorns. And it was a student who got me hooked on this right before COVID. And it is a great way to get into ETFs. Again, it's like a mutual fund. It holds those assets. Acorns will help you establish an account, and as a college student, you get very low very low fees taken out. You can create a Roth IRA or a traditional IRA in an investment account right on your phone. Now, that takes a lot of the fear and overwhelmingness of trying to. I really want to get my IRA created today, but I know I got to go to the broker. I don't know what they're going to want. Maybe I just don't feel comfortable with that. I just want to do it on my phone. Well, here it is. So here's the website right there. Again, I do not get any kickbacks from this. Okay, just want to let that know. There's no conflict of interest here. I think it's great because you can really get into the investment world. Again, Robinhood, love that one too. Robinhood single stocks. This is ETFs. Again, like a mutual fund. It takes about 20 minutes to get in. It operates on roundups. So the same thing, it connects to your bank. Once you get $5 worth of roundups, and you can peg your roundups to be 50 cents, $1, or 5 times the amount of whatever the roundup would be. So if I was a 50-cent roundup from $1.50 to $2, it would put $2.50 into my account at a 5x. So you can have a lot of fun with this. It basically asks you some questions, your age, where you are, and it says this is what we believe is the perfect exchange traded fund for you. It's got a mix of bonds, it may say, and stocks. So it may say 70% stocks, 30% bonds. It may go 80-20. And you can also now in Acorns, so I'm able to buy Berkshire Hathaway as well as Apple stock in there. So they've kind of taken a little bit from Robinhood. I hope I'm not overselling this. I also teach marketing. I have come from a business sales background. But when I do find something that's this great, and again, when college students, these are game changers right in here. Fidelity, Vanguard, big old firms. They have gone to this too, app trading, because so much money is always going into the market, which is why it's gonna be hard to predict the next really big market downturn, because so many people are plugging in to these apps, and of course mutual funds for their 401ks. I mean, money's coming in every month, and as long as people are working and funding that, it's going to keep driving the stock market up. So those are the assets it can hold. Again, you'll have an investment account, but you could certainly start a Roth IRA. Just give you a little preview to that. Unless you're making over, as a single person, about $100,000 a year, you can start a Roth IRA. If you're married, as long as you're not making over 210, the numbers change every year, then you can go into the Roth. The Roth IRA, my friends, is tax-free for life. You do not get a tax deduction off your adjusted gross income. You don't care about that. You want tax-free money, and this is a great way to do that, and you can pop it together. Everything that we've just talked about, from the stock investing to the exchange traded funds and the mutual funds too, do it all on your phone. How does that sound? Here is what we would look at just for looking at a little bit of research. So for my online course, and it's right here. There's fidelity.com. See a nice bigger picture of that. I want to go to research. I want to go, all things I could look at. I'm going to go ahead and just check out mutual fund research. So probably predominantly, if you just start that new job, or you're in your job right now and you haven't checked your 401k in a while, there could be a chance Fidelity is the custodian of that. So that's what the company goes through. And so now I look at my asset categories. Let's just go allocation. Let's go all asset classes. Let's just have this. The risk by Morningstar. You know what? We're going to put a little bit higher risk in here. Okay, let's see what we get. We're going to look at fund picks from Fidelity. All right, now I got 27. Management approach. Let's see returns. Let's see what we get here. Well, we want high returns. All right, let's just go high as possible. 2 funds. All right, let's go to this high right in here. They got 17 funds to look at. Morningstar picks overall. Morningstar is a different company that rates the mutual funds. Some investors say, "Oh, I don't care what they're doing. I know enough, and I'm happy with the returns." We can just maybe put in medium right in here. And expenses, we don't care about expenses right now. All right. With that, it's going to generate what my criteria was. So what we'll look at is the first one that comes up with, we've got global stock. There's a real estate investment one from portfolio from Fidelity. So if you want to say, hey, I like hard assets, I want real assets, I want land, buildings, this might be for you. Emerging markets, okay, this is where large investment companies say, all right, what are some of the emerging markets? We saw turn of the century an acronym called BRIC. All right, Brazil, Russia, India, China. Those are emerging economies at the end of the last century and that were going to take off. And so I believe it was Shearson Lehman, American Express, looked at those areas and what they need and invested in companies in those areas. And so that's what we're looking at different markets that are coming through. Natural resources, again, if I want that, you can just go in there and have a lot of fun right in here, my friends. And Fidelity, I pick Fidelity because it makes it so easy to do some mutual fund research. What over here, I like this, okay? So the life of the fund, the 10-year fund, the 5-year fund, the 3 years, that's the results. So if we look at commodity stock right in there, it has given us a 5.5% return for the life of the fund. We know it's been around at least 10 years because it's given us a 10-year of 4%. The last few years have been really strong. Again, coming out of 2022 into 2023, the stock market was rechurning itself. And so there were some low results. And year to date, this fund has not done that well. Well, we had some really great year in 2023. There could be some profit taking earlier in this year. There's a lot of different reasons. But you're saying, okay, well, what else do I do? Well, I'll just click this right in here. And now it details that fund. Okay, it tells me all of the things that I need to have in there, that the returns, that it is a higher return, it's an average expense. So my expense is still under 1%, it's 0.94%. It was funded in 2009, okay? And so it's still a relatively young fund. Again, you'll be able to find different ones. There's the net asset value at $16.84 per share. Turnover rate, again, how we're churning different stocks. Portfolio just gives us a little bit right in here. Now, if I keep going down, if I want to find the top 10 holdings, so almost half of this fund, these are the companies. So we have ExxonMobil. Right? That's one of the biggest companies in the world. We have Shell, so those are definitely natural resources. Archer Daniels, a lot of this looks like energy and natural resources right in here. So again, this is definitely sectored in, but it just tells you what we're invested in. There's our fund manager. You can get more information on who this person is. Again, it will also match against other funds. You can look at fees, composition, ratings, performance, risk, commentary. You have a lot of different aspects that you can look in your investigations, my friends. And this is a great way to do it. So you'd find the funds that you want to research in. Even if you don't buy today, you could say, I'm going to track these and see how well they do. Well, if I come down here to emergency, looks like it's been a tough year for a lot of funds. Well, I'm making this video in February, so it's just the start of a new year. And again, there could be a lot of profit taking from the end of last year, and so we could be rebalancing ourselves. We look at different lives of the funds, and that's a great way to say, hey, let's look for a double digit. Well, there's a double digit right there, okay? And that's what it has had. Any other ones that we are seeing in the lifetime of a fund, that's close enough, that's almost 10. And this is what it's done recently. So, again, maybe want to look at some of that. Energy, precious metals, real estate, that tells you exactly what the bigger categories that we are in. I like this natural resources, Mellon Natural Resources. It has some really big years. Again, right now, natural resources, we are still in different war zones. We have a Ukraine-Russian war still going on. And that's certainly affected the price of energy, and so a lot of different effects that could happen. But we're not looking for 1 year, are we? We're looking for a long haul. See if you can find other funds, my friends, that were from the 70s, and if they can come with a close to 9 to 10% lifetime return, that has weathered a lot of storms. The recession of the 70s, the boom of the 80s, the quick bad recession, early 90s, early aughts, 2007 to 2012 recession, and they're still making money. That's nice. That's nice, because we're going to more than likely put these in our funds. And again, as I go over in the retirement area, all right, our estate planning and retirement, you can have several of these funds once your 401k or your IRA gets strong enough. $2,000 or $3,000, $4,000, $5,000, $10,000. You can start splitting those into. I'll put 25% here, 25% here, and I'll go look for different ones. So now you have diversification among diversification. So I hope that helps you in the mutual fund area. Fidelity they just put it out so nicely where we can start looking and researching and building accounts. We can put those into just basic accounts, investment accounts. It's a nice way to start the investment world. The apps do make it really, really fun to do. So in your investing strategies, again, if you were to say, I want to find 5 funds, and most companies will let you do this. I want to find a growth, aggressive international, aggressive growth bond fund, natural resources. So for every $100 I put into that account of mine, 20% goes here, 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 here. Now you've got a lot of diversification. And do this for the next 40, 50 years. Every month hit it. That's the way you will certainly build well over $1 million worth of assets. So you have money to spend later on in life. And how great is that? So there's our manner. Again, we could do 4 funds, we could do 5 funds. That's what we want to look at in the investment. We've gone into the stock market. We've gone into different markets now, and we've diversified, so we're still getting some risk in here, and we're getting reward, and we don't have to manage it every single day. You don't have to worry about ups and downs of that. Something else to put in your portfolio? Great, have some single stocks, but definitely look at this, and this is going to be the driver of your retirement planning. And we'll talk more about that in the retirement section. Hope you enjoyed this short video.